Hello everyone, my name is Xiang and today I would like to continue my series on bad debts. So today we'll specifically look at provisions for bad debts. But then before we make provisions for bad debt, we just want to do a quick recap on the meaning of bad debts. So bad debts are just irrecoverable debts that we cannot recover as a result of customers refusing to make payment of their debt when they fall due. So it is important that the accountant make provisions for bad debts. And that is the focus of today's video. If you have not watched the video on bad debts, I would advise that you watch that video before watching this video because that is going to help you understand this video very well or this concept very well. Okay, so what is provisions for bad debt? That is our focus of today's video. So provisions for bad debt or a provision for bad debt is just an amount that we set aside in order to cater for bad debt. So it's just an amount that we set aside in order to meet bad debt. Okay, so that is it. We are expecting that customers may not pay some portion of their debt when they fall due, or we expect that this customer, after making several efforts in order to recover our amount or our debt from him, all our efforts have not yielded the results that we want. So as a result, we just have to declare that portion of his debt as bad. And then in accounting, we have this key concept that actually talks about more provisions, and that concept is prudence concept. So prudence concept is saying that an accountant should not be in a haste in order to anticipate for profit, but the accountant should rather make provisions for possible losses. So any provision that we make in accounting is just in conformity to the prudence concept, which is saying that an accountant should rather make provisions for possible losses, like provision for bad debt, provision for depreciation, and it shouldn't be in a hurry in order to anticipate for profits. But then the focus is not on provision for depreciation, provision for um, discount, but then the provision that we are going to look at for today is provisions for bad debts. Okay, so how do we make provisions for bad debt? Because when you say it that accountants should make provisions for bad debt, how will the accountant make provisions for bad debt? So that is what we are going to look at today. So in order to make provisions for bad debt, it is the provisions, the percentage of provision, okay, then we apply it on the debtor's figure. So it's just a percentage of provision, then we apply it on a debtor's figure. So the question will give you that, sorry, will give you the percentage of provision. So it will tell you that the provision for bad debt is 10%, provision for bad debt is 5%. Sometimes the question will even give you the actual provision, but then we are looking at how do we get the actual provision. So it is the percentage of provision, then you apply it on the debtor's figure. Why are we applying it on a debtor's figure and not on any other figure? We are applying it on a debtor's figure because bad debt actually comes from the debtor's figure. So you have a debtor who is refusing to pay, and as a result, you have declared him as bad. So bad debt is more or less like originating from the debtor's figure. That is why we need to make provisions on the debtor's figure. So it is the percentage of provision on the debtor's figure. Okay, so we'll look at a typical scenario here. So provision sometimes in the course of running a business, it could be that this is the first time we are making provision. So if this is the first time you are making provision, then it means that when you take your trial balance, there is nothing like provision in a trial balance. So it means that that is the first time we are making provision. So if we look at our trial balance over here, we have debtors figure, we have bad debt. There is nothing like provisions here. So this is the first time we are making provision. So if there is provision already existing in a trial balance, you will see it here. in a trial balance. Okay, so this is the first time we are making provision. And what is the question saying about a provision? So the question is saying that provision for bad debt is 10%. Most of the times, the question will tell you that a provision for bad debt is 10% on debtor's figure. I just want you to know that even if the question does not tell you that 10% is on the debtor's figure, you should know that the provision that we are making is against bad debt, which is coming from the debtor's figure. So the 10% should be applied on the debtor's figure. So in making provision, it is 10% here, which is the percentage of provision. Then we apply it on the debtor's figure, and then we get 550. Now, after getting the 515, that is not all. That is just the first step towards our goal. Our goal is that all that we are doing is to be able to prepare our financial statement for us to report an accurate figure on the face of the financial statement. For us to be able to balance our financial statement, these adjustments are necessary for us to do so that we'll be able to balance off or to be able to prepare our financial statement. Now, provisions are expenses. Any provision that we make, provision for bad debt, provision for depreciation, these are expenses. Well, we are setting money aside to cater for some of these things. But then these are more or less like there are a lot of explanations to this, yes. So, but then what you have to know is that provision is an expense. Well, when I say when you set money aside, it's more or less like we don't mostly set physical cash aside because it's more or less like a notional cost. I mean, but then don't worry, all that you need to focus on is that the 10% is on the debtor's figure, which is the percentage of provision on the debtor's figure. Okay, but then the provision you are making is an expense. And in accounting, we have where expenses are supposed to go. So when I'm preparing my profit and loss account, then I match my revenue against my expenses. So this expense will go to the P&L, profit and loss, because I want to know my profit. And as part of my expenses like salaries, wages, stationery, light and heating, electricity, and all that, as part of these expenses, then I add provisions for bad debt as part of my expenses. So the 550 will go to P&L. Good. One thing that we need to know is that anything under additional information, we treat it twice. So we do it 2 times. Anything under the additional information, any transaction under the additional information, we treat it twice. Now, if you see any transaction under the additional information, then it means that the double entry has not been done for that transaction. If the double entry has been done on that transaction, then it will be in a trial balance. Because before an item will come into the trial balance, then it means that we have done the double entry, balance of the various accounts, and then we'll bring their closing figures in a trial balance. Because trial balance is just a summary of all the account balances. So before an amount or before a figure will come in a trial balance, then it means that we've finished doing the double entry and we've just taken the balances to the trial balance. But then if the item is not in a trial balance and it's under the additional information, then we treat the item twice. So how do we treat the item twice? So the first one is what we have done by taking it to the profit and loss. Then the next one is we need to take it to the balance sheet because we established the fact that bad debt in our first video, we said that bad debt has the effect of reducing the debtor's figure. So is the provision on bad debt. So if I have my debtor's figure here and I reduce it by bad debt, I should also reduce it by my provisions for bad debt for the year. Good. So how do I go about this? So Debtors are assets. They are part of our current assets. And as a result, it will go into the balance sheet. So when I go to my balance sheet or my statement of financial position, SOP, when I go to my statement of financial position, I'll have a portion for current assets. So let me represent it by CA, current assets. Under my current assets, I will list my inventory, I will list my debtors, I will list my cash. So my debtors figure, which is the 5,500, then I will less my provision for bad debt, the provision for bad debt. So I will less provision. So P, let me represent it by P, provision for bad debt, which is 550, 550, so that I will know my net debtors figure. Okay, so first of all, we need to know that provisions are made on the debtors figure. So it's the percentage on the debtors figure. And then when I'm done, the amount that I've gotten is just a mere calculation. I need to know the accounting treatment. So it will go to the profit and loss account and then also go to the balance sheet. If that is the first time we are making provision, then the same amount will go to the profit and loss account and that same amount will go to the balance sheet. But if you are making a subsequent provision, or if we have provision already, then you are making another provision, then it is not the same amount that will go to the profit and loss, and it is also not the same amount that will go to the balance sheet. So stay tuned, keep watching these videos, like the videos, subscribe to the channel, and you will get to know of how we'll be able to go about when we are making subsequent provision. And that is what we are going to consider in our next video. Thank you for watching and share this video. And I believe that this video will go a long way to help people to understand accounting. Thank you very much.